Hi, welcome to today's class. Welcome to today's class and meeting. This is still a regular Forex instructor, Godwin. Alright, today we're going to be talking about types of market. Types of market. Some persons will be like, what is he trying to talk about? What is he trying to talk about today? What is it all about? Now, what I'm trying to talk about is the basics. The basics are very important in the market. What is very important, what is key in the market, because outside this you wouldn't be able to be profitable. You can't be profitable in the forex market without knowing the different types of market we have. What do I mean? When you go to your chart, when you get your chart, you see your chart going either upward or coming downward. You see those candlesticks. The formation of those candlesticks gives us a pattern known as charts. So you see those charts going upward or moving downward. You see them moving or either up or down. You can never see a market moving in a straight line just like this, and you can never see a market moving in a straight line downward like this. But you see them, they have a particular pattern they move. All the market, whether you're trading currencies, whether you're trading stocks, whether you're trading metals, whether you're trading indices, whether you're trading cryptocurrency, whatever you're trading, market do not move in a particular or in one direction, but it has its own pattern. It moves. Why do market move those way? Why is it that market moves in this pattern and not in a straight line? Why is it that market will move in this pattern but not in a straight line? Have you ever asked yourself that question? Why is it that market moves in a particular pattern but not in a straight line? And sometimes when you open the chart, it's either heading downward or it's moving upward or it's moving sideways. Have you ever asked yourself why? And when it is moving upward, what should I do? When it is moving downward, what should I do? When it is moving sideways, what do I do? Now take note of this. When the market is moving upward, follow the direction of the market. And when the market is moving downward, always follow the direction of the market. Now there are three types of market. Traditionally, there are three types of market traditionally. We have the trending market, we have the ranging market, we have the choppy market. We have the trending market as a trader, we have the ranging market, and we have the choppy market. Now we move over to the trending market. Now under the trending market, we have the bullish trending market and the bearish trending market. Now what does this trend mean? Now if you're a trader or you're a forex trader, you've been trading before now, or you learned under many instructors and the rest. Now they will always tell you, make the trend your friend, make the trend your friend. Making the trend your friend, you have solved over 50% of your problem in this market. Trading in favor of the trend, following the trend, doing whatever the trend is doing, you have solved 50% of your problem in this market. What do I mean? Trading against the trend, especially as a newbie, is like swimming against the ocean. It's like swimming against the ocean. So one of the ways for you to be profitable in this forex market is for you to always trade in favor of the trend. Always trading in favor of the trend. What does that mean? If the trend is bullish, you go bullish. If the trend is bearish, you go bearish. What I mean by bullish is this. If the trend is buying, uptrending market, you either call it the bullish trending market or you call it the uptrending market. And we have the bearish trending market, or you call it the downtrending market. Bullish trending market or the downtrending market. When a market is trending upward or moving upward, it's known as a bullish trending market. And when a market is moving downward, it's known as a bearish trending market. This is what I'm trying to tell you or show to you. Now you can look at this. look at this. The market, is it heading up or downward? You can see that the market is heading downward. So this is simply a downtrending market. And sometimes you see the market making this move to the upside. Whenever you see the market making the move to the upside, it's known as an uptrending market. Now, the truth is this: when I tell people, please spot an uptrending market for me, they'll be like, oh, that stuff is too hard, or whatever is moving up is an uptrending market, whatever is moving down is a downtrending market. No, that's not it. That's not it. Yes, traditionally, generally, whatever is moving up is an uptrending market. But how do you spot it in the market and trade judiciously with it and make profit with it? So we'll move over to the characteristics of each of them. Now we'll move over to the characteristics of the uptrending market. Characteristics of the uptrending market. Number one, the market must have a low, the market must have a high, the market must have a higher low, and the market must have a higher high. The market must have a low, the market must have a high, the market must have a higher low, and the market must have a higher high. So this is a good example of what I'm trying to show us. So looking at this, you see this is a low, here is a high, here is a higher low, here is a higher high. So this is the progression, or this is the pattern the market moves. This is the progression, or this is the pattern the market moves. The market does not move in one direction. So for an uptrending market or for a bullish trending market, you always find the market having a low, a high here, a higher low, and a higher high, a higher low, and a higher high, a low, a high, a higher low, and a higher high. Now that is it for an uptrending market. So let's go to our chart, see if you can spot it. Now I know before going to the chart now, some persons on their mind will be like, oh, what causes the market to move in this pattern? Why is it that market cannot move in a straight line? Why is it that market cannot move in a straight line but in this pattern? Now the answer is simple. It's simply the law of demand and supply in the market. It's simply the law of demand and supply in the market. Demand and supply in the market. Now when you get your chart, what makes this market to move up or down? What makes the market to move up or down, or to be in an uptrend or to be in a downtrend, is the money pushed into it. As a matter of fact, the Forex market do not know you, and it doesn't know me. The Forex market doesn't know if you're a trader or not. The Forex market doesn't know if I'm a trader or not. Remember, this Forex market cannot be controlled. Nobody controls this Forex market. Rather, it can be influenced. So what makes the market to either be in an uptrend or in a downtrend is the money pushed into it. Is the money pushed into it. Now, when you see a market in an uptrend, it means the buying pressure, the amount they are using to buy the market, is higher than that of the sellers. And when you see a market going downward continuously, it simply means the amount they are using to sell the market is simply higher than those of them buying the market. So what this market respects is the money pushed into it, and not individuals nor faces in the market. What do I mean? If all the retail traders in the world coming together, let's say they go for Euro USD or for GBP USD, shorting Euro USD or shorting GBP USD with a selling pressure of, let's say, $1 billion, and 2, 3, 4 market makers or big boys in the market come together, say, man, I would like to push this market high. I would like to push this market high. I would like to buy this market. I would like to buy this market. And they push in money worth up to $5 billion for a buy. Meanwhile, all the retail traders, including you, are selling the market. Where do you think the direction of the market will go? it will be up, 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 up. What the market expects is the money pushed into it, and that's why you see your Bitcoin rising or you see your Bitcoin falling. Your Bitcoin rising simply means there are a lot of buyers, or they are pushing much more money into the Bitcoin, and when they pull that money, you see Bitcoin dropping. So what actually makes this market to move in this pattern is simply the law of demand and supply. The more money is pushed in, you see the market going high, going high, going high. Now what these market makers do is this: they push in high amount of money, a reasonable amount of money at the low. Let's say for something to be high, it must be at the low. So that means market has been selling, 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 and they wish to push the market high. So what happens? How do they do that? How they do that is this: they push in money higher than the sellers, or the selling pressure, the amount they use in selling the market. So the market causes a first spike in the market, or a spike upward for a buy. Then at the end of the day, they pull out half of the money they pushed in, or half of the money the big boys pushed in. When they pull out half of the money, you see a retracement, pullback, or correction in the market. Now they must do that because they know that market does not move in a direction or in one direction. In as much as they pushed in high amount of money, they must pull out half of their money because they know that market does not move in one direction. Market must retrace. And why must market retrace? Market retraces in order to gain momentum. Retracement is for the market to gain momentum. Now before I go ahead, the movement in favor of the trend is known as impulsive move. The movement in favor of the trend is known as impulsive move, while the one against the trend is known as correction, retracement, or pullback. So market must always do a retracement, just like this retracement. This is retracement. So market must always do retracement, correction, or pullback for it to continue and moving upward with a spike or whatever. In order for the market to gain momentum, market must always do a retracement. So the big boys, they pump in their big money for a spike in the market. At the end of the day, they remove part, it causes a retracement, pullback, or correction in the market. They pump more money, you see a spike. When they remove part of the money, you see a retracement, correction, or pullback. They pump more, you see a direct shoot upward. So I believe you're understanding this and getting it properly. Now one thing is for you to be able to spot it on the slide I'm using right now. Another thing is for you to spot it on the chart. Some persons will be like, oh, the same thing you draw on the whiteboard or on the slide is not still the same thing I'm seeing on the chart. Now one thing is for you to see it on the slide, another thing is for you to see it on the whiteboard. So let's go to the chart and see if the chart can replicate what we are trying to do. So for an uptrending market, let me see if I can get a good one for you. I'm seeing a lot of them here, but I'm looking for one that will be you will be able to understand quickly before I get to all these other bigger ones, so let's see. Let's see. Okay, let me quickly use this. Now looking at this, you find out that the market is in an uptrend. Now is this not a low? Is this not a high? Is this not a higher low? And progressively you see your higher highs and the rest. So the market made its first move here, did a retracement, continued. Market must always do a retracement in every aspect. Market must always do a retracement. So let me quickly open another chart for us. Okay, let me open the Okay, this USD CHF pair. Okay, now look at this. Is this not a low? This a low here. This a high. This a higher low. This a higher high. This a higher low. This a higher high. So it must not be the same way it is on the slide, or the same way I drew it on the slide. So you can see this is our low here. This is our high. This is our higher low. This is our higher high. Higher low. Higher high. So don't always expect it to be perfect. So all you got to do is to be able to spot it on the chart. This our low here. This our high. This our higher low. This our higher high. Higher low. Higher high. So you always see the market moving progressively in that manner. You can see that the market didn't move in a straight line. So that's how the market moves. Now the question is this. When you spot a trend, now this is a low, this is a high, this is a higher low, this is a higher high. Now, where do you take your entry in the market? Where do you take your entry in the market? Where do you take your entry in the market? When you spot a particular market, where do you take your entry? For an uptrending market, where do you take your entry? Now, in an uptrending market, take this down, take note of this. You only think of buying the market. Don't say you want to trade in favor of pullback. Yes, there are situations you trade in favor of pullback or corrections and still make money. But if you are new into the market, consider trading in favor of the trend alone, exclusively in favor of the trend alone. So this is an uptrend and you want to buy. Remember, in an uptrending market, you only think of buying the market. So let's say you want to buy. Now, this is a low, high, higher low, higher high, higher low, higher high. So it's moving boom, boom, boom towards that direction. So right now, if you spot the market at this particular place, is it advisable for you to buy the market? Traditionally, you spot the market at this place, is it advisable for you to buy the market? No, no, because here is, if you buy the market here, over time you'll be profitable, but there is possibility for you to secure drawdown or loss in the market before entering, a reasonable loss before entering profit. So in every trending market, buy when the market has done a retracement. In every trending market, only buy when the market has done what? A retracement. What do I mean? In an uptrending market, only buy in a higher lows. Higher lows. So this is our low, this is a high. So this is low, this is a high. So you wait for the higher low, higher high, higher low. This is your point of entry when market has come back to the nearest zone or nearest zone. I took zonations in the market. If you've not watched, you can always go ahead, watch it. Also remember to share this video, subscribe to the channel, share to your friends, so by the time I post more videos, you will be able to spot them and use them judiciously in your favor. So in an uptrending market, especially your major pairs or whatever you trade, you buy at higher lows. Traditionally rather, there are points you buy at higher highs, but that's on a professional level, and that's during breakouts. Yes, during breakouts in the market. But for now, buy at higher lows in the market, not buying at higher high. If you buy at higher high, subsequently you make profit, but your risk to reward ratio is going to be affected in the market. So we move to the next type. So we have the downtrending market. We have the downtrending market. Now characteristics, it has a high, it has a low, it has a lower high, and it has a lower low. So it has a high, it has a low, it has a lower high, and it has a lower low. So you have to put all this into consideration. So a good example of the downtrending market is something like this. Something like this. Now this is the high, this is the low, lower high, lower low, lower high, lower low, lower high, lower low. Now in every down trending market, you enter the market in a lower high, not lower lows. Like look at, if you catch the market here, is it good to sell here? Yes, if you sell, subsequently you're gonna make profit. Always wait for the market to make a retracement or a pullback before entering the market. So let's see if we could see example here. Yes. I thought I saw one for us. Alright. So let's see if we can see anyone. So we've seen one. Now looking at this, you'll find out that this is a downtrending market. This is a downtrending market. I told you, one thing is to be able to spot it on the slide, another thing is to be able to spot it on the chart. Now look at here, this is a high, this is a low, this is a lower high, this is a lower low, this is a lower high, this is a lower low, lower high, lower low, lower high. So in a downtrending market, you take your entries in a lower highs. So wait for the market to make a retracement or a pullback. This is a retracement, this is a retracement before taking entry in the market. So spotting an uptrending market or downtrending market is so easy, very easy in the market. All you have to do is to be very conservative. So we move ahead to the next thing we have on the slide for our class today. We have the ranging market. Now what is a ranging market? A ranging market is simply known as a sideways market. A ranging market is a sideways market. It's not trending upward, it's not trending downward. It shows indecision in the market. Whenever you see markets not trending upward or downward, just moving sideways, it shows indecision in the market. Shows indecision between buyers and sellers in the market. So what do I mean? Now let's see if we could spot anyone. Now look at this. There was a range here. The market didn't go up or come down. Now whenever you spot a ranging market also indicates to you that there is possibility that the market would reverse. There is possibility that the market will reverse whenever you spot a ranging market. Now you can see the market was buying, but when it got to this particular place, it couldn't take up this zone here, this resistance zone. It come here, testing it here. So market respect, and likewise here too, trying to break the support, no way, trying to break the support, no way, finally broke it. So whenever you spot a ranging market, what I advise for newbies and those of them entering the market for the first time, avoid the market. However, you can also make money from this ranging market. All you have to do is to buy along zones. What do I mean? You wait for it at the support. By the time it has given you a candlestick confirmation, you buy. You wait for it at the resistance zone. By the time it has given you candlestick confirmation, you sell until you find a breakout. Else, avoid the market. So let's see if you can also spot more ranging market on the chart. It's not difficult to spot. It's there. If it's not there, it's not there. Now look at this. It's also ranged here. So let me see if I can spot others. Let's see. Oh my goodness, just take a good look at this. Don't expect it to be perfect, that the highs and the lows, the peak and the trough must be the same. No, the peak and the trough must not be the same. Now take a good look at this. market ranged here. When he got here, he couldn't take off these highs. When he came here, couldn't take off these lows. Here, couldn't take off these highs. Couldn't take off these lows. Couldn't take off these highs. Couldn't take off these lows. Couldn't take off these highs. Not even these lows, until at the end of the day there was a breakout. So if you wish to trade your ranging markets, if you already know what you're doing, just buy and sell at the support zone pending the time there is a breakout in the market. But if you are new to the market, only trade your normal trending market. So for the choppy market, choppy market is just like an imperfect market. It's not trending upward. It's kind of like, it's like a ranging market, but it's not a perfect ranging market. But if you understand your ranging market, you will be able to understand your choppy market. So as a way to recap, to go through what we did today, we started with types of market. For you to know, when you look at the chart, you see the chart either moving up or coming down, why it moves that way. We shared three types. We have the trending market, we have the ranging market, and we shared the choppy market. We went ahead to talk about the bullish trending market. Under a trending market, the bearish trending market. So for the bullish market, it has four characteristics, which is the low, the high, the higher low, and the higher high. So we went ahead to give you a practical example here, which is the the diagram here. This is the low, this is the high, higher low, higher high, higher low, higher high. And we also established that if you wish to buy in an uptrending market, wait to buy at the higher lows. When the market make a low or a higher low, you can now take entry for a buy in that particular market. We also went ahead to talk about the downtrending market. We said it must have a high, a low, a lower high, and a lower low. So we gave a good example here. You can see high, low, lower high, lower low, lower high, lower low, lower high, lower low. So we went ahead to establish that if you wish to sell in a in a downtrending market, sell at lower highs in that particular market. Sell at lower highs in that particular market. So we also talked about the ranging market. I said it shows indecision in the market, or you can also say it shows equality between buyers and sellers. Market is not moving up, market is not coming down. It's just moving sideways along the zones, along the support and resistance zones in the market. So whenever it's spotted, you either trade it as a zone. When market comes to support, you buy. When market comes to resistance, you sell. When market comes to support, you buy. When market comes to resistance, you sell. Just like what we established on the chart, just like this: buy at the support, sell at the resistance, buy at the support, sell at the resistance. This is only good if you know what you are doing and you are professional in the market. But if you're a newbie, only wait for a trending market before you go in for either a buy or a sell. So we now talked about the choppy market and imperfect market. So that is it for what we have today. Thank you very much. Do well to share, subscribe, so that by the time I post more videos on this same channel, you will be able to receive them. So thank you very much. Bye.